All right, welcome back everyone. Another video for you guys today. Today we're going to do Five Below. So I always get interested in stocks that are dropping a lot and I like to dig deeper. Currently year to date, we're down 45% on Five Below. Let's go ahead and check out what's going on. If we go ahead and take a look at the chart real quick. Price at it's now, it's $118. Going for around 6.5 billion. Price it's at now is pretty much what the price was back in the summer of 2022. It's the same price it's selling at 2 years ago. So yeah, check out summer of 2020. It's selling for around this price too. So pretty much from 2020 till now, if you would have been investing in this company, you would have pretty much had no gain. And at the same time, this company has been growing for the past 4 years. So for those who live under a rock, Five Below is pretty much a discount retail store. They try to sell everything $5 and under. They do sell things above $5, but most of the stuff they sell is pretty much $5 and under. I think I've only been inside Five Below like one time. I'm looking through their website and they have some pretty cheap stuff. Bluetooth headphones for $7. Look at this folding camp chair for $7. An inflatable kayak for $25. I'm going to have to make a little run to Five Below and check out what they got. So first thing first, on their latest Q1 2024 earnings transcript, to talk about how it's a more difficult macro environment because of inflation. They've also cut their full year forecast. There's been weaker spending among consumers in the lower income bracket. Okay, another thing they talk about, they bought too much supply. So this is from MarketWatch. Squishmallows are creating a tougher bar to clear for Five Below. So I guess they bought too much of these squishy toys and they can't sell them anymore. Weaker spending among its lower income shoppers and bigger difficulties navigating life after last year's Squishmallow boom. That's just a brief summary of what's happening. That's causing the stock price to go down. Again, we're at $118, $6.5 billion valuation. Year to date, we are down 45%. Let's go ahead and take a look at the financials and see if this company is undervalued. We're currently sitting on 8 consecutive quarters of total revenue growth year over year. So they do have a couple down quarters on earnings per share. Their most recent reported down 14%. For retailers, one thing I like to look at is inventory levels. So this is going to be quarterly inventory level. The question you want to ask is inventory growing faster than sales? So if we take the average 5 years, average for the 5 years, inventory is growing 7% and revenue is pretty much growing double that. So that's a good sign for this company. Total revenue is growing year over year and inventory levels are staying steady. All right, let's talk about what's next for Five Below. So when you read through the transcript, they talk about the number one focus, and that is growth. So let's talk about store expansion real quick. How much do they plan on growing this year versus the next couple years? Currently, Five Below has 1,600 stores, and they have a roadmap to 3,500 stores nationwide by the end of 2030. Let's see how many stores Five Below had around 2021 compared to today. All right, so this is from Statista. So in 2020, 2021 had around 1,000 to 1,200 stores. And at the present moment, they're at 1,600 stores. So they've added about 400 stores in the past 2 years. And the value of the company has stayed the same. By 2030, they want to have double the amount of those stores, 3,500 stores nationwide total by 2030. In the first quarter alone of 2024, they've opened up 61 new stores. So it does look like they are going to be pretty aggressive in opening these stores, and they want to open up to 230 new stores for the rest of 2024. So pretty aggressive growth strategy, and that's definitely going to help the top line. As of right now, in my opinion, I feel like Five Below kind of just hit a little speed bump. I just want to go over some last couple numbers right now. All right, first things first, cash. They're currently sitting on $460 million in cash with no long-term debt. So once again, a company with no long-term debt, there's no way they can go bankrupt. Next number we're going to look at is retained earnings. What is retained earnings? Pretty much it's a portion of the company's net income that's not distributed as dividends to shareholders. Basically, it's the money that they retain and they reinvest back into the business. So pretty much every year for the past 8 years, Five Below has been increasing the retained earnings. So they're keeping a lot of their cash that they're earning and they're reinvesting it back into the business, which is a good sign. And so we're just going to take a look at other numbers. So every year they are still growing, not as much as they were back in 2020, 2021, but they are still growing. Gross profit margins for Five Below are hovering around 35%. They're earning positive net income. Latest net income they reported through around 300 million, and earnings per share has been on a good growth trajectory. Let's see how many shares they have. Pretty consistent outstanding shares. With the price at $118, I do feel like they're going to start buying back their own shares. So these three things I have highlighted right here: return on capital employed, return on total capital, and return on capital. So these are pretty much all financial ratios that measure a company's profitability and efficiency with the capital that they're employing. And what I just want to look for in these numbers is consistency. Today, let's just go over return on capital. It helps investors pretty much understand how well a company is using its resources to create value back to their shareholders. So a higher return on capital indicates that the company is more efficient at converting their capital into profits. This could also signal competitive advantage. And as you could see, for the past 3 to 5 years, pretty consistent on return on total capital. Another good one to look at is return on equity. It's the best way to measure yearly performance. And again, you want to look for consistency. And for the past 10 years, they have been pretty consistent at producing similar return on equities every year. All right, this is just a quick little review and some key financial metrics that I wanted to point out that sort of stand out the most to me. Again, like I said earlier, Five Below just hit a little speed bump. Company with around $420 million in cash, selling for $118 at a $6.5 billion valuation with consistent financial metrics just like that. They are going to keep moving on with their aggressive expansion plans. Again, tripling their store base to 3,500 stores by 2030. Five Below has a strong balance sheet. So if you are looking to invest in this company, I think in the near term, the stock is going to be a little bit volatile still. They are having problems with shrink. The recent sales numbers and earnings per share numbers that they are posting aren't meeting analyst expectations. So in the short run, I feel like there is going to be a lot of volatility with this company, but if you are a long-term investor, definitely take a look at this stock. Let me know what you guys think, because I do think this company is a little bit undervalued. But yeah, I'm going to end it at that. Thanks for watching. See you guys in the next one.